we have world-renowned economist Ken Rogoff, who's the former IMF chief economist and now professor of economics at Harvard University. And Ken joins us here in Hong Kong, and he's here to give the keynote speech at Asia Pacific, a debt investor forum, which is taking place later on this morning here in Hong Kong. Welcome back to this part of the world. How are you this morning?
I'm good. How are you?
Yeah, good. Hopefully you're not too jet-lagged.
Not too jet-lagged.
Not too jet-lagged. Well, let's talk about the global recovery, because we talked about Paul Krugman and also Nouriel Roubini. Krugman, in fact, says we're in a third depression, and there's talk of double dip. What's your view?
Well, you know, anything's possible, but that's certainly not my view. So far, the run-up into the financial crisis and the aftermath has very much tracked what Carmen Reinhart and I find in our work and in our book. And, you know, the bad news is the recoveries are very slow. You don't get a V-shaped recovery. The good news is they recover. I mean, most economies, the crises end. We've had them for 800 years, which we studied in the end. So the fact that we're not growing super fast doesn't necessarily say, well, therefore, we're about to enter something worse.
Now, what about this debate about whether to get into austerity measures or add more stimulus to economies? Because Paul Krugman is saying that we're going to see this third depression because governments around the world in this time should not be having their deficits and cutting back on spending.
You know, I couldn't disagree more. I mean, I think that if you ask what happens if we get into another depression, if something really goes wrong, it's going to be one of two things. First, the central banks just say, we're bored with this easy monetary policy, let's just tighten. Well, that would cause a big problem. But I think the larger risk is government debt problem. Again, my work with Carmen Reinhart, we find that after a big financial crisis, like we saw after a wave of them, then like day follows night, you get sovereign debt crises within a few years because the budgets explode. And just because we're not feeling that everywhere now doesn't mean it's a risk. It hits you wham very suddenly. Obviously, if the economy starts just completely falling apart and there's a panic, you have to use what fiscal policy tools you can. But just to keep drinking, you know, bottles of aspirin because you're worried you're going to get a headache or it's going to turn into a migraine is not, you know, it's too much prophylaxis.
Yeah, what about that Greek debt crisis? You know, of course, it sparked a lot of concern this year. But interestingly enough, when people are talking about double dip, you're saying that the U.S. debt crisis in Greece will actually not overwhelm the positives that we're seeing in the U.S. economy. What sort of positives are you seeing? We had manufacturing numbers disappoint, you know, housing numbers still lagging the market, and of course those jobs numbers on Friday that a lot of people wouldn't take a lot of positives from.
You know, it's all relative to expectations. I was never calling for a V-shaped recovery because after a financial crisis, you don't get a typical recovery. I never thought housing prices were going up again. I think they still have further to go. We shouldn't have been expecting this fast recovery, and now the data are more consistent with that. But it doesn't necessarily mean, you know, we're about to be going into negative territory. It's possible. It's certainly possible. But, I mean, I wouldn't say that's at all the baseline case.
Okay. Can you give some probability then to a possibility of, say, a decline in the U.S. recovery? You know, people are still calling for double dip,
mean recession.
Right? Yeah, recession.
I think it's about as likely as in a random year. So we have a recession once every 8 or 9, 10 years. So, you know, those are about the odds. It definitely can happen, but I wouldn't say it's an elevated risk.
That's interesting that you're putting the odds on a recession in 8, 9, or 10 years, because you actually shocked the market back in February when you were in this part of the world, in Tokyo, I believe, talking about China possibly getting into a financial crisis in the next 10 years. And in fact, people are looking at some of the numbers that have been coming out of China recently. You know, shockingly, power usage is sharply down last month. And then you have car sales, which also slowed dramatically as well.
Well, you know, China's the classic this time is different story where people come to believe it can never have a normal recession like everybody else. Of course it can. And as it normalizes, as it grows, as it becomes a more sophisticated economy, and especially the speed it's growing, it's going to have bumps, whether the data report it or not. And so, you know, 10 years without having a recession, I think it's pretty unlikely.
Yeah, you're talking about this bursting of a debt-fueled bubble, and with growth rates falling to 2 to 3% in China, which is kind of unfathomable considering we're seeing double-digit GDP growth, right?
Not unfathomable if you look at the history of the world, and other countries have been growing that fast. It doesn't mean you're not doing well, but there's volatility. To think it's just all upside volatility, not downside, it's absurd. And yes, there is some slowing down going on.
Yeah, but Ken, I wanted to pick your brain in terms of what's telltale signs to you would show that China is heading for this bursting of the bubble.
Well, there's nothing harder than looking at an economy where you don't have much data, so, and the data is not very reliable. You're really picking at very, things that are hard to see. But property prices and leverage are probably the two best indicators that you have a problem. Exploding property prices and leverage. They're far from perfect. So just because you see it doesn't mean you're going to have a crash tomorrow. It could be 5 years, an occasion, it could be never. But they've got it. I mean, there's no question. You're starting to see that collapse in property. That's going to hit the banking system. And they have a lot of tools and some, very competent management, but it's not easy.
Yeah, one of the tools they have, of course, is the currency exchange rate. There's a lot of debate about the yuan these days. As you know, we have the rhetoric coming from Schumer and Graham saying do something about your undervalued currency. It's about 40% undervalued in their views. Do you think that we might be heading towards a trade war between the two? Because there's a tussle. Obviously, China doesn't want to move because they want to protect their exports. And then, we have U.S. politicians wanting to protect jobs.
Well, I think the underlying fact is China cannot keep growing its exports to the rest of the world at the same pace it's been doing. It's just impossible. It's like, a child can't keep growing at the same rate they do from ages 0 to 5, or they'd be like the Empire State Building. It's not possible. And so at some point they have to redirect their strategy. I don't really think there'll be a trade war, but it's certainly true that the U.S. is weak. Its unemployment's high. President Obama's poll ratings are falling. And, you're nervous. I think China made a master stroke, really a master stroke, with announcing the flexibility just before the G20. And nobody quite knew what they meant, but it sort of pushed the issue off the table.
Now, Ken, quickly, because we're running out of time here, I want to talk to you about those bank stress tests taking place in Europe, because you did predict that a big bank would fall before Lehman's did. Do you think we'll see some insolvent European banks, say, in the next year or so?
Well, there are a lot of insolvent European banks, and the question is whether we'll see them because they give us decent data. I think a fair amount of the European banking system, has moribund banks in there. Some of the governments have trouble. They need a lot of restructuring. They're in denial in Europe. It is a manageable problem, but not if they stay in denial.
We had to go to commercial break, but thank you for dropping by. Nice seeing you.
My pleasure.